This is MacroVoices with hedge fund manager Eric Townsend, the free weekly financial podcast targeting professional finance, high net worth individuals, family offices, and other sophisticated investors. MacroVoices is all about the brightest minds in the world of finance and macroeconomics telling it like it is, bullish or bearish, no holds barred. Now, here are your hosts, Eric Townsend and Patrick Ceresna.
In any event, Patrick, let's move on to this week's Postgame chart deck. Registered users will find the download link in your Research Roundup email. If you don't have a Research Roundup email, just go to our homepage, macrovoices.com, look for the red button that says Looking for the Downloads. Nick Galarnik joins us now in the Postgame segment as a new member of the Postgame staff. Nick, welcome aboard.
Glad to be joining the team. This week's chart deck is titled, What's Next for the Markets? Patrick, we're going to kick things off with a chart of the S&P 500, which is trading at lows of the year as we speak. If we break the 3,500 level, it's probable that we test the 3,400 area, which is a pre-COVID high mark. What do you think about this?
Well, exactly. I marked on this chart this previous low from June. And not only did we test it and bounce yesterday on Wednesday, but, the rally lasted a whole few hours. It basically made it up just barely above 3,700. Any meaningful bounce should have easily been able to make it back to 3,900. And immediately we come in this morning with another round of selling. It's like being at the edge of a cliff. At this moment, if these previous lows give out, there becomes an air pocket. The first target is exactly about 3,400, like you were saying. It's I concur with that number. But, the question is what's driving this? If we continue to see that something is broken and it's really driven some sort of a liquidity event. The question is, do we see some sort of, multi-sigma move to the downside that causes some sort of final capitulation event that might wash us out to 3,200 or 3,000? Now, I'm not predicting that, but these are the types of conditions where we have to be aware that things like this can happen. And it's certainly going to be really interesting. The first thing is obviously to watch throughout today and tomorrow whether the previous low holds.
On the next page, we have a chart of the VIX, which is trading near 33. This tells us that we can expect more than 2% daily moves in broad markets and signals risk off. What are your thoughts here, Patrick?
Well, that's exactly it. 2% swings in the market is just par for the course now, right? So anyone surprised by 100 S&P point swing shouldn't be. And, the fact that we're over 25 and now above 30 is just really showing that it's really risk off at this moment. The bigger question is there going to be just one blow off? Now, again, the market can hold these lows and can bounce, and this could become the short-term high of the VIX. But if we do see that the selling kicks into lower lows and it becomes more of a liquidity event, one would expect that we could have a very short-term spike in the VIX that blows it even north of 40 in that environment. Now, I think that any spike up there would be probably short-lived, but the fact that all year we've put in our highs around this 33, 34 area, and the fact that we're near year lows, it certainly is a lot of anticipation as to whether that kind of event can occur. So now let's move on to page 4 here, where I have that US dollar chart. And we had that almost accelerated explosion higher up toward 115. Didn't quite hit it there, but it really did. And at least it's pausing right now. Now, to me, just because such an overbought condition has caused the dollar to pause is not enough for me to in any way speculate that this is already a major dollar top. To me, even a pullback to 111 on the dollar index would be just a natural retracement to what it's going to be about here is that typically you see these 3 or 4 day pauses in a currency move and then it blasts off and continues in prior trend. Will we see that repeat itself, or is this going to start to form something much more of a meaningful reversal? And it's really early to be able to tell that here.
Eric, what are your thoughts on the USD?
I think what's important to think about now is how the apparent blow-off top in the dollar plays out. Are we going to see it go substantially down, back down to 100, meaning that this was a major top? There's a new trend that might come into play now. Or is this just going to pull back to 108, 110, and then move right on back up and move to new highs above 116 or 115, whatever the number was that we put in earlier today? I think it's really, really important to understand, are we going to just see a pullback? Are we going to see a change? This blow off top should be a significant event. If it went much farther than it already went, if we got into the 120s, I would say that's getting into a real danger zone of the appreciation of the dollar blowing up emerging market debt and generally blowing up the rest of the global financial system. So I think if you saw the dollar go radically higher than the recent high, which I think is the most unlikely scenario, it would be a really, really dire warning signal. What's much more likely is this plays out as a blow-off top that, there's going to be some down now after the blow-off top. How much down? Is it a really big blow-off, or is it just a blow-off shaped pullback before the rally resumes? That, I think, is what's most important to watch.
On the next three charts, we're talking about the pound, euro, Canadian dollar, which have all been decimated recently. What are your thoughts on these charts, Patrick?
Oh, we got to start with that pound. I mean, we can talk about the interest rates in England in a moment, but what a capitulation. I mean, we saw a 1,000-pip move literally within less than 24 hours of trading. And it really was just one big washout. What we saw was obviously an intervention by the Bank of England, and that certainly alleviated some of the most immediate stresses and caused the bounce back. I mean, I think that at this stage, it's fair to speculate that even if the dollar continues higher, it's entirely possible that this washout could even mark the low already of the pound sterling. So often you might see scenarios where that bottom is retested. I mean, if we have another dollar run on the upside, the pound could retest its lows. But I think at this moment, when you see that kind of a crash event washout, that much of a currency move, that low that was established is going to technically mean something. And so that's going to be really interesting in the coming weeks how this plays out. When we go to the euro, on the other hand, it did have a weakness. It certainly continues to deteriorate, and we now have finally seen the break of the parity level. With this breakdown move now occurring down to 95, 96 cents, it's actually achieved many of my downside targets. I find it really hard to be bearish the euro here from the price level, but certainly the trend remains incredibly weak. All rallies are failing, and there is no evidence that a new uptrend has yet begun. Any bounces here, they could sneak up to 98, 99 cents, but at this moment, unless we see a meaningful shoot above parity, I would be very alert about them turning right back down to retest the lows. And the last one we were mentioning there was that Canadian dollar. Looking at that USCAD, just an explosive move in the last 2 weeks. The US dollar against the Canadian dollar has been probably one of the more stable currency pairs that have been out there all year. And suddenly the US dollar rally just kicked in, and we saw almost a 700 pip move in 2 weeks. We're really seeing the entire currency markets really wobbling as the US dollar rally just is simply the most dominant trend out there.
Absolutely. Yeah. Watching the Canadian dollar fall about 8 cents in a couple of weeks is pretty alarming. But on page 8, we have a chart of crude oil now.
Yeah, and let's talk crude. I mean, Eric was referencing this downtrend, and really to me, though, it's all about the price action. It seems every time there's one of these 2, 3, 4-day rallies, it barely does a 50% retracement of the rally and immediately starts to sell again. The point of high interest now, to me, is around this 85-cent level or $85 level. If we see that these little rally attempts in crude oil can't beat 85, they could roll over and head right down to the mid to low 70s. To me, the only way the bulls are going to neutralize the sell cycle is to legitimately clear 85 and get it close to 90 again and let it stop making lower lows. Then we'll see much more neutral price action that actually could set up a bullish turn, and that simply is not there yet. Okay, so moving on to page 9, I just wanted to touch here on gold. And so gold, in my mind, has now completed a move to the downside. This kind of 1620 area was initially a target for me if it was to break to a lower low where it could go. With this bullish engulfing candle coming in here, or at least a bullish reversal candle, to me, we're going to get a little bit of a bounce, but there's so much repair work the bulls have to do to turn this back up. I mean, we could, even if it rallied to 1700 or 1710, could very easily just roll right back down and retest its lows. I think for gold, we're going to have to really see a US dollar top establish itself, and that would correspond with potentially with a basing formation where gold could put in a bottom, and just doesn't seem like that's there yet.
Eric, what are your thoughts on gold?
Well, today's green candle is certainly exciting, but what did it do after moving so far up in one day, all the way back up to what, 1670 almost? It's still $10 below what we used to think was a bottom that we hoped would hold. So how much further we go from here? The stock market didn't even get really to new closing lows. I think that the stock market is probably not done here. If the stock market goes to all-out crash, I think it takes gold substantially lower. But let's see what happens. It does feel like there's at least a short-term bottom in.
Moving on to page 10 here, I have this chart on the 10-year government bond yield. And, guys, we hit 4%. It's unbelievable. I thought 3.5% was going to be such a huge hurdle, and the bond market just continues to get hammered on every single front. We obviously had the first tap of 4% create a little bit of a rejection here on the 10-year yield. But you know what? We've seen these temporary pauses for a couple of days, and then it just resumes. It's too early to know for a fact that some sort of a top has formed here. So much of these things have been hitting these extremes. It'll be really interesting to watch how the next week of price action continues to develop here.
Eric, what do you make of the U.S. 10-year bond yield is trading up to 4%?
I'm not sure if we went over 4% briefly intraday. I saw 3.90 something on the 10-year yield on Thursday, and needless to say, that is pretty darn quick appreciation. Everybody thought 350 was never going to happen just a few weeks ago, and already we're flirting with 4%. This is definitely what to watch. It does feel like maybe we just put in a bottom in yields, top in the dollar index. Question is, how long does that trend go? So let's see what happens.
On page 11, we have the UK 10-year. This is where the carnage has been of late.
Oh, for sure. And what is interesting, and obviously the Bank of England intervened, and some people were skeptical of it. But when you start reading some of the stories, it was clear that there was some sort of a pension meltdown that forced that Bank of England to intervene, because the rumor was that the UK bond markets barely dodged a Lehman Brothers-like collapse. But this time it was obviously those pension funds that were the center of the event. Some sort of pension plumbing is causing this mess, and it'll be really interesting to see whether this intervention was enough to stem the bleeding. I mean, we saw the yields go from 1.7% on the gilts all the way up to like 4.5% in just a span of 2 months. Unbelievable move in this, and this is really starting to demonstrate the fact that the broader intermarkets are starting to break, and we're seeing things just accelerating into panic modes. It really makes me feel like even if things do get worse first, that something is going to give here in October. Like it's just unbelievable to see these types of moves.
Absolutely agree. And on the next 3 charts, we're talking about the mortgage REITs, investment grade corporate bonds, and junk bonds. Now, what are your thoughts on these charts, Patrick?
Yeah, I was looking at these mortgage REITs, and I've been trying to be far more positive on these. And in the last week, it's simply been a fail. I mean, at this moment, there seems to be almost no money out there, and there seems to be real selling, particularly even potentially from pensions and other types of funds that are stuck in the liquidity period, and these things are just getting hammered. And so with this current pullback, you're seeing just an outright acceleration to the point that these mortgage REITs are going back to the 2020 repo crisis period. It's like lightning striking twice. I'm finding it a little bit shocking to seeing this much carnage in these mortgage REITs. But last time around when they got here, it ended up being quite a buying opportunity, but it really feels like a very dangerous game trying to catch this falling knife. When we go here to investment grade corporate bonds, what we have to touch on here is that everything is selling. The investment grade corporates, even though the credit spreads, though, rightfully so, have not been blowing out in a crazy way. This has just been a bond market carnage right across the board. Whether it's this investment grade bonds on page 13, or whether it's the high yield bonds or junk bonds on page 14. Everything is getting hammered. Everything is getting hurt. And the problem is, how can the stock market rally when there's this much carnage in the bond markets? To me, the market just still is in such a critical stage. And while there's a risk of everything still getting worse, it just feels like we're very close to some sort of a washout in all of this. It would be a shocker to me if this ended up being one extended bleed.
Folks, if you enjoy Patrick's chart decks, you can get them every single day of the week with a free trial of Big Picture Trading. The details are in the last pages of the slide deck, or just go to bigpicturetrading.com.
That concludes this edition of MacroVoices. Be sure to tune in each week to hear feature interviews with the brightest minds in finance and macroeconomics. MacroVoices is made possible by sponsorship from BigPictureTrading.com, the Internet's premier source of online education for traders. Please visit BigPictureTrading.com for more information. Please register your free account at MacroVoices.com. Once registered, you'll receive our free weekly Research Roundup email containing links to supporting documents from our featured guests and the very best free financial content our volunteer research team could find on the internet each week. You'll also gain access to our free listener discussion forums and research library. And the more registered users we have, the more we'll be able to recruit high-profile feature interview guests for future programs. So please register your free account today at macrovoices.com if you haven't already. You can subscribe to MacroVoices on iTunes to have MacroVoices automatically delivered to your mobile device each week free of charge. You can email questions for the program to mailbag@macrovoices.com, and we'll answer your questions on the air from time to time in our mailbag segment. MacroVoices is presented for informational and entertainment purposes only. The information presented on MacroVoices should not be construed as investment advice. Always consult a licensed investment professional before making investment decisions. The views and opinions expressed on MacroVoices are those of the participants and do not necessarily reflect those of the show's hosts or sponsors. MacroVoices, its producers, sponsors, and hosts Eric Townsend and Patrick Ceresna shall not be liable for losses resulting from investment decisions based on information or viewpoints presented on MacroVoices. MacroVoices is made possible by sponsorship from BigPictureTrading.com and by funding from Fourth Turning Capital Management, LLC. For more information, visit macrovoices.com.